Welcome to the 90th episode of Kanga Crypto News, your weekly briefing for crisp, dependable updates from the crypto world. I'm here to break down the stories that matter the most and the numbers behind them. Before we start, a quick note. Everything you hear on Kanga Crypto News is researched and prepared by expert Kanga analysts using reliable sources only. But this is not an investment advice. We release new episodes every Friday. To stay on top of the most important moves in crypto, subscribe to the channel and tap the notification bell. Now, let's get into it. At the end of December and the very start of January, global media and intelligence-linked reports circulated claims about the temporary detention or forced removal of Venezuela's President Nicolas Maduro during a covert operation linked to internal and external political pressure. While official details remain limited and narratives differ depending on the source, the event was widely treated by markets as a short-term geopolitical shock. Crypto reacted almost immediately. Bitcoin moved higher in thin holiday liquidity, briefly pushing above $94,000 level, while Ethereum climbed back towards the $3,200 range. Importantly, this happened while traditional markets were either closed or operating with limited hours, making crypto one of the only global markets available for real-time risk repricing. Derivatives data suggests that move was amplified by positioning. According to exchange data, a cluster of short liquidations hit the market in the hours following the news, accelerating the price action rather than creating it. This points to a classic short squeeze dynamic rather than a fundamental repricing of crypto's long-term value. Why did crypto react at all? Historically, digital assets often act as a first response market during geopolitical uncertainty, especially in regions with a track record of capital control, sanctions, or currency instability. Venezuela is a textbook case. The country has been years of hyperinflation, dollar shortages, and informal crypto adoption, particularly Bitcoin and stablecoins, as tools for value transfer and capital preservation. That context matters, but it is equally important to be clear about what did not happen. There was no confirmed on-chain movement of state-held crypto reserves. There was no evidence of forced liquidation, sanctions-driven wallet activity, or systemic disruption to crypto infrastructure. The reaction was narrative-driven and short-term. Another layer was speculation. Social media and trading forums circulated unverified claims about Venezuela holding large, undisclosed Bitcoin reserves accumulated through years of sanctions evasion and energy for crypto arrangements. Estimates ranged wildly, some claiming hundreds of thousands of BTC. There is no on-chain proof to support these figures and no official confirmation from any authority. Still, the rumor itself added fuel to volatility and discussion. Prediction markets also lit up. Platforms like Polymarket saw a spike in volume tied to geopolitical outcomes linked to Venezuela and broader regional instability. While these markets do not move spot prices directly, they often reflect trader sentiment and risk perception in real time. So what is the takeaway for crypto markets? First, crypto continues to function as a global always-on risk barometer. Second, geopolitical shocks can move prices quickly, but those moves are often liquidity and positioning driven rather than fundamentally justified. And third, the market is increasingly mature in how it absorbs these events. After the initial spike, prices stabilized and returned to tracking ETF flows, macro signals, and institutional activity. And with geopolitics adding short-term volatility, attention quickly shifted back to what institutions and regulators are doing next in crypto markets. Now we can calm down a bit. Morgan Stanley has officially filed for Bitcoin and Solana ETFs in the United States. This is not a crypto-native firm experimenting at the edges. Morgan Stanley manages over $5 trillion in client assets and serves some of the largest institutional investors in the world. The filing signals two things. First, demand from clients is no longer theoretical. Second, major banks now believe regulatory conditions are stable enough to justify launching crypto-linked investment products. Solana's inclusion is particularly notable. Until recently, ETF conversations were focused almost entirely on Bitcoin and Ethereum. Adding Sol suggests institutions are widening their demand of investable crypto assets. When banks like Morgan Stanley move, distribution follows. These products could eventually be offered to wealth clients, pension-linked portfolios, and institutional mandates that cannot touch spot crypto directly. This illustrates the ongoing integration of digital assets into traditional wealth management frameworks. Staying with ETFs, the broader market entered 2026 with renewed momentum. In the first trading days of the year, spot Bitcoin and Ethereum ETFs recorded combined net inflows of roughly $646 million. This reversed a 7-day streak of net outflows that closed out December. Bitcoin ETFs led the rebound, but Ethereum products also saw steady demand. The timing matters. This came just as macro uncertainty around rates and geopolitics pushed investors back towards large, liquid assets. For institutions, ETFs remain the cleanest on-ramp, especially for year-opening portfolio allocations. December data also revealed an interesting rotation. Ripple-linked ETFs absorbed approximately $483 million in net inflows during the month, while Bitcoin ETFs recorded more than $1 billion in net outflows. This does not mean institutions are abandoning Bitcoin, instead it suggests diversification. XRP saw increased activity tied to ETF developments and its role in payments infrastructure. For asset managers, this is increasingly a relative value trade inside crypto, not a binary bet on one asset. Price-wise, Bitcoin started the year trading near $92.5 thousand. That places it below recent highs, but still firmly within a historically strong range. Volatility cooled compared to late Q4, and derivatives funding rates normalized, suggesting less leverage in the system. From a market structure perspective, this looks like consolidation rather than distribution. Long-term holders remain inactive, while short-term flows are increasingly driven by ETFs and macro-sensitive capital. Ethereum showed relative strength, holding above the $3,200 level despite mixed market sentiment. Network usage remained stable and staking ratios continued to climb. For institutions, Ethereum's role is increasingly tied to tokenization, real-world assets, and settlement infrastructure rather than pure price speculation. That narrative aligns closely with how now banks and funds are positioning Ethereum inside multi-asset crypto products. Now, to regulation. Goldman Sachs published research stating that clearer regulatory frameworks will be the main catalyst for institutional crypto adoption in 2026. According to Goldman, uncertainty, not volatility, has been the biggest blocker for traditional finance. With ETF approvals expanding and compliance standards becoming clearer, crypto is shifting from an experimental allocations to structured asset class. This does not mean explosive upside tomorrow, but it does mean deeper integration into existing financial systems. Zooming out, issuers expect 2026 to be one of the most competitive years for crypto ETFs so far. Bitcoin and Ethereum remain the core, but filings are expanding towards Solana, XRP, and multi-asset baskets. Regulatory tailwinds are improving, but competition will compress fees and push issuers to differentiate through structure and access. Finally, a key supply-side event to watch. Ripple is scheduled to unlock roughly 1 billion XRP in January. Historically, not all unlocked tokens enter circulation immediately, but the event still matters for liquidity and sentiment. Combined with ETF flows, this creates a complex setup for XRP. Increased supply on one side, growing institutional interest on the other. How Ripple manages distribution will be closely watched by both traders and long-term investors. Overall, this week started to be defined by institutions moving from observation to execution. Morgan Stanley stepping into ETFs, capital rotating inside crypto assets, and regulators providing clearer frameworks. Then, Maduro got captured, and crypto received a bump as non-TradFi assets. Short-term, sentiment is mixed. Long-term, Crypto continues to integrate into the core plumbing of global finance. That's it for today's Kanga Crypto News. If you enjoyed the episode, like, share, and subscribe. Thanks for watching and stay informed, and I'll see you next week.
We are Kanga, beyond crypto.